Okay, so today we're going deep on building an investment strategy that can really stand the test of time.
Right.
And we're focusing this one specifically for you, the defensive investor.
Exactly.
Now we've got some really incredible guides for this exploration.
Yeah.
First, we're tapping into the wisdom of Benjamin Graham from his classic work, Chapter 5, The Defensive Investor in Common Stocks.
Right.
And this was written a while back.
Yes, it was.
But the insights, honestly, they're still shockingly relevant even today.
Oh, they really are.
And to bring it into the present,
Yes.
we've got Jason Swide's super sharp commentary on that very chapter.
Great insights.
And so our mission here is to really distill those essential principles from these sources
Yeah,
so that you can walk away with a clear, actionable roadmap
absolutely.
for building that long-term success without needing to be glued to the market every single minute.
Right.
So let's unpack this.
All right.
One of the things that really struck me when I was rereading Graham was his argument for even including common stocks in a defensive portfolio in the mid-20th century.
Interesting.
You know, back then, stocks weren't always seen as this must-have investment.
Right.
And he was really making the case for why you needed them.
Yeah, he was laying the groundwork.
And as I was digging into it,
Yeah.
it became clear that his core reasoning really centered on two key benefits for you.
Okay.
So first and foremost, protection against inflation,
Right.
which traditional bonds just didn't offer.
Nope.
And then second, the historical track record of common stocks to deliver those superior returns over the long term.
Yes, through dividends and the power of reinvesting those profits.
Precisely.
Advantages you just wouldn't find with bonds.
Exactly.
But there's a catch.
Oh, absolutely.
Graham was very clear that these advantages, they kind of disappear.
They vanish.
Yeah, if you overpay.
Exactly.
He even points to those excesses leading up to the 1929 crash
Right.
and the inflated prices we saw around 1971.
Yeah, those serve as a stark reminder.
Big red flags.
For sure. So the takeaway right from the start for you
Yes.
is that value matters,
It always matters.
even for the long haul.
Couldn't agree more.
And what I found really interesting
Okay.
is that even by late 1971,
Yeah.
with the Dow Jones Industrial Average hovering around 900, Graham wasn't exactly what you'd call bullish on the stock market.
Not exactly.
Right, but here's the thing.
Okay.
He still firmly believed that a defensive investor
Right.
had to allocate a significant chunk of their portfolio
Mm.
to common stocks.
Even then.
Yeah, even if he saw it as kind of the lesser of two evils at that moment,
Interesting.
compared to holding only bonds,
I see.
it really highlights his long-term perspective.
Absolutely a lesson for us all.
And speaking of essential principles,
Okay.
for that common stock component,
Right.
Graham lays out these 4 bedrock rules for stock selection.
Yeah, let's dive into those.
So rule number 1 is diversification.
Okay.
But he's not talking about owning every single stock under the sun. He recommends a minimum of 10
At least 10.
and a maximum of about 30 different stocks.
So what's the logic there?
Well, I think for you,
Yeah.
that minimum of 10 is really about mitigating your risk,
Right.
spreading your investments across at least 10 companies.
You're not putting all your eggs in one basket.
Exactly.
If one or two hit a rough patch,
Yeah.
it doesn't wipe out your whole portfolio.
Exactly. And that maximum of 30,
Okay.
I think, reflects the point where the benefits of additional diversification,
Yeah,
they start to become marginal.
I see.
And it gets really difficult for someone like you,
Yeah.
who's not aiming to be an active trader,
Right.
to really understand and monitor
Ah,
a huge number of companies.
makes sense.
So it's about finding that sweet spot
Yeah,
of protection without making things too complex.
absolutely.
Now, rule number 2 is all about quality.
Okay, quality of the companies.
Exactly.
Makes sense.
Graham says they should be large, prominent, and conservatively financed. Now, even he admits those terms are a bit subjective.
Right.
But what kind of companies do you think he had in mind for someone seeking that stability?
Well, luckily for you,
Yeah.
he actually provides some more specific guidelines a bit later in the chapter,
Okay.
though he calls them arbitrary. But
Right.
they're helpful.
Yeah.
So for conservatively financed industrial companies,
Okay.
he suggests that the value of their common stock at book value.
Now, just as a reminder for our listeners, book value
Yes.
is basically the value of a company's assets
Right.
minus its liabilities.
Exactly.
So what's left over?
Right.
Okay, so that common stock at book value
Yeah.
should be at least half of their total capitalization,
Right.
which is the total value of a company's equity and debt.
Including any bank debt.
Got it.
And for railroads and utilities, he sets a benchmark of at least 30%.
Okay.
And then to define large back in his day,
Yeah.
he proposed a company with either at least $50 million in total assets
Well.
or $50 million in annual business.
Okay.
And remember, this is back in the 1970s.
Right.
Much different scale than today.
Oh, yeah.
And for a company to be considered prominent,
Yeah.
he said it should be ranking in the top quarter or top third in terms of size within its industry.
So basically well-established leaders with strong balance sheets.
That's a good way to put it.
Right. More assets than debt,
For sure.
which means greater financial resilience.
Right.
Okay. So rule number 3
All right.
focuses on dividend history.
Okay.
So we're talking about a long and consistent track record of dividend payments.
I see.
And he even points to the Dow Jones Industrial Average in 1971,
Okay.
noting that all of its components at that time met this criterion.
Yeah, interesting.
And he suggested a requirement of continuous payments since at least 1950.
Wow.
So why do you think this steady dividend payout was so crucial for him?
Well, I think for you,
Yeah.
it really boils down to what signifies a stable and reliable business.
Right.
Because a long history of consistently paying dividends
Yeah.
signals a company that's weathered different economic cycles and consistently generated enough profit
Right.
to share with its shareholders.
Yeah, it shows they're not just hoarding cash.
Exactly.
They're sharing the wealth.
And that aligns perfectly with the defensive investor's goal,
Right, which is...
seeking stability and minimizing risk.
Exactly.
Oh, yeah.
Okay, so rule number 4.
Right.
This one might be the toughest for a lot of investors today.
Oh, yeah.
Price limits. So Graham suggests not paying more than 25 times the average earnings
Okay.
of the past 7 years.
7 years.
And no more than 20 times the earnings of the last 12 months.
Okay.
Now, that's the price to earnings ratio.
Push to E ratio.
Exactly. And it basically tells you how much you're paying
Yeah.
for each dollar of a company's profit.
Right.
And he even states outright
He does.
that this rule would exclude almost all growth stocks.
Interesting.
Why do you think he took such a strong stance?
Well, I think for you, it comes down to the foundation of Graham's philosophy.
We'd like-
Value, not speculation.
Got it.
And growth stocks, by their very nature,
Yeah.
tend to trade at high PE ratios
Right.
because investors are banking on future growth.
They're betting on the future.
But that introduces a huge speculative element.
Right.
So if that growth doesn't materialize or
Yeah.
if the market takes a turn, these pricey stocks can plummet.
Fast.
And for a defensive investor who's trying to avoid those big losses,
Yeah.
that level of uncertainty is a no-go.
I see.
It's just too much volatility.
And he gives some great real-world examples to illustrate this.
Yeah.
He talks about IBM,
Okay.
which delivered phenomenal returns over the long term,
Right.
but still had these significant price drops during certain periods.
Right.
And then there's Texas Instruments, where the price went up 5 times faster than its earnings,
Oh, wow.
only to see both of them plummet later.
Yeah.
So it's that concern about the price getting ahead of the actual value of the business.
Yeah, the fundamentals.
Exactly.
It's a key point for you.
Right.
Because Graham's saying that for the average investor
Yeah.
who's looking for a steady path,
Mm-hmm.
these large, often less popular companies
Yeah.
that are available at more reasonable prices,
Right.
they offer a much more sensible approach.
Less exciting,
Maybe?
but definitely more sensible.
Right. It's about consistent returns over time,
Exactly.
not chasing those huge gains that could disappear just as quickly.
Now, once you've built this defensive portfolio,
Okay.
what about managing it?
Good question.
Graham mentions making changes, periodically reviewing your holdings.
Mm-hmm.
So for you as a defensive investor,
Yeah.
what's the key insight here about when and how to make those adjustments?
The big thing Graham emphasizes is that if you chose your stocks well initially
Right.
and really stuck to those 4 rules.
Those 4 rules we just talked about.
Good.
You shouldn't need to make frequent changes.
Okay.
He even suggests seeking advice from a reputable firm, at least once a year, just to check if your portfolio still aligns with those criteria.
So it's about those initial choices leading to stability, minimizing the need to constantly tinker
Exactly.
or react to every little market blip.
Right.
You're in it for the long haul.
And another interesting concept he champions
Okay.
is dollar cost averaging.
Yeah, he called it a monthly purchase plan.
So for our listeners who haven't heard of this,
Yeah.
can you break it down for them?
Sure.
And explain why Graham was such a big fan?
So dollar cost averaging
Yeah.
is basically investing a fixed amount of money
Okay.
in your chosen stocks or funds
Right.
at regular intervals.
Like every month.
Exactly like clockwork.
And the advantage?
The beauty of it,
Eh.
you automatically buy more shares when prices are low
Oh, I see.
and fewer when they're high,
Okay.
without trying to time the market.
Thanks.
Graham even brings up this study by Lucille Tomlinson, which looked at decades of data on the Dow Jones using this method.
And what did it find?
It found a profit in every single 10-year period they tested,
Wow.
with an average profit of over 20%.
That's impressive.
And that's not even including dividends.
Right. Right.
So her conclusion was pretty powerful.
What did she say?
She said that no other investment formula
Yeah.
gives you as much confidence of success.
Regardless of what the market does.
Exactly.
That's a huge endorsement.
It is.
And I know some of you might be thinking,
Yeah.
well, what if I don't have the funds
Right.
to invest regularly?
A valid concern.
And Graham addresses that.
He doesn't.
He points out that as common stocks have become more accepted
Right.
as a part of savings programs,
Mm-hmm.
these systematic purchases
Mm-hmm.
become much more doable
Exactly.
for a lot of people.
More accessible.
So he's really emphasizing that potential
Yeah.
for long-term wealth building through those consistent, even small monthly investments.
It's the tortoise and the hare all over again.
Right. Slow and steady.
Wins the race.
Now, Graham also points out
Okay.
that your personal circumstances
Right.
should play a big role
Mm.
in your investment decisions.
Makes sense.
And he gives 3 distinct examples.
Okay, I'm listening.
A widow with a large sum of money,
Okay.
a successful doctor with regular savings,
Right.
and then a young person just starting out.
Got it.
So what were the key differences
Yeah.
in his recommendations?
Well, the big thing he emphasizes
Yeah.
is that your financial equipment.
And what does that mean exactly?
So that includes your knowledge,
Okay.
your experience, and your temperament.
Mm,
Those are even more critical than just how much money you have.
interesting.
For the widow,
Yeah,
where preserving capital is paramount,
right.
he suggests a roughly equal split between high-quality bonds
Okay.
and sound common stocks.
Got it.
And he strongly advises against any risky ventures.
Yeah. No gambling to
Right.
try and boost income.
Exactly.
To try and boost income.
It's just too dangerous.
And for the doctor,
Yeah.
with those steady savings, similar principles apply.
If they're not actively managing their investments,
Right.
stick with a similar portfolio split.
Oh, okay.
Invest those savings proportionally.
Got it.
And Graham makes an interesting observation here.
What's that?
He says that professionals, like doctors,
Yeah.
despite being successful in their fields, can
Yeah.
sometimes be overconfident investors
Really?
and end up unsuccessful.
Wow.
Because they might not have the time
Right.
or the dedicated approach to really analyze those security values.
That's a good point.
Yeah, and for the young person just starting out,
Yeah.
the defensive approach is, again, a logical starting point.
Okay.
It's simple and it's effective.
But he doesn't discourage younger people from being more hands-on.
No,
Right.
not at all.
Right.
He acknowledges that many young people are interested in finance,
They're curious.
and he sees the value in learning early on.
Even with some mistakes along the way.
Yeah, you learn by doing.
Right.
His advice to beginners
Go.
is to study those principles of valuation and to test their judgment with small amounts.
Right. Don't go all in right away.
Exactly. Build that foundation first.
Okay, let's talk about Graham's note on the concept of risk.
Interesting topic.
Because his view on what actually constitutes risk,
Yeah.
especially with common stocks,
Mm-hmm.
it's a bit different from the conventional wisdom.
So how does it differ?
Well, he challenges the idea that bonds are inherently less risky than preferred stocks,
Okay.
and preferred stocks less risky than common stocks, which leads to that fear of common stocks being unsafe.
Right.
But he argues that the word risk
Yeah.
is often used in 2 different ways.
Okay, I'm listening.
First, the risk of default
Right.
or dividend cut,
Okay.
and second, the risk of selling at a loss.
Because the price went down.
Exactly.
I see.
And Graham says for a long-term investor, like, a temporary price drop that doesn't force a sale
Right.
isn't the primary risk.
Hmm.
He compares it to a mortgage holder or a business owner.
Interesting.
Their main risk isn't the day-to-day fluctuation in market value.
Right.
It's the potential for losing their capital entirely.
Yeah. Or not being able to meet their obligations.
Exactly.
So what does constitute real risk for a common stock investor?
Well, according to Graham,
Okay.
it's a permanent loss of capital,
Okay.
a deterioration of the company you invested in,
Right.
or paying way too much for a stock
Overpaying.
relative to its true worth.
Got it.
And he argues that a well-diversified portfolio
Uh-huh.
of carefully chosen stocks
Yeah.
held for the long term
Right.
has historically been safe
Safe.
despite those market ups and downs.
Interesting.
So he thinks it's misleading
It is.
to call it risky
Yeah.
just because the price fluctuates.
Right.
The danger is in overpaying.
Even if you might eventually recover those losses.
Okay, now lastly in this part, Graham has this note on the category of large, prominent, and conservatively financed corporations.
Yeah, where he gets more specific.
Exactly.
So what are those benchmarks?
Well, he says for industrial companies
Yeah.
to be considered conservatively financed,
Uh-huh.
the value of their common stock at book value should be at least half of their total capitalization.
Okay.
And for utilities and railroads,
Yeah.
it's 30%.
Got it.
For large, he suggests $50 million in either assets
Okay.
or annual business.
Okay.
And for prominent,
Yeah.
they should rank in the top quarter or third in terms of size.
Within their industry.
Exactly.
Okay, that's helpful.
Yeah, these are just guidelines
Right.
to help you avoid those trendy picks
Yeah.
without a solid financial foundation.
Makes sense.
So that gives us Graham's core principles.
Yeah, solid base.
Now, Jason Zweig brings in some really relevant commentary,
He does.
highlighting some modern challenges.
Okay, I'm intrigued.
And the first one is defending against the brokerage industry. So what's he saying here?
Well, he points out this conflict of interest
Aye.
that you as a defensive investor
Oh, yeah.
need to be aware of.
What is it?
So defensive investors, they don't trade very often,
Right.
which means they don't generate a lot of fees.
For the brokerage firm.
Exactly.
Yeah,
And
yeah.
Zweig argues that this democratization of investing.
Yeah, with all the low-cost trading apps,
Right.
it can be deceiving. It might sound good,
Yeah, it sounds great.
but it can actually encourage you to trade more, which makes the brokers more money,
Uh-huh.
but it doesn't necessarily mean better returns for you.
In fact, it could be harmful.
Yeah. So just remember
Yeah.
that the broker's incentives,
Yeah.
they don't always align with your best interests,
Good reminder.
especially as a buy and hold investor.
Right.
Zweig also emphasizes the importance of defending against social contagion.
What does that mean?
It's about protecting your intellectual independence.
I like that.
So when you start relying on other people's opinions,
Yeah, like blindly following the latest hype.
exactly, or getting caught up in the market frenzy,
Yeah.
you're basically giving up your ability to think for yourself,
Right.
which is your most valuable asset as an investor.
It makes sense.
And that can lead to some serious financial losses.
Because you're not making decisions based on your own judgment.
Exactly.
And by the time you realize it.
It might be too late.
Right.
He then dives into this really interesting distinction
Okay.
between gambleification
Hmm.
and gamification
Interesting.
in these trading apps.
Okay, I'm curious.
So can you explain this for us?
Sure.
And why he sees so many of these apps as gambleification.
So true gamification is
Yeah.
about using game-like elements to make valuable activities more engaging.
Like learning or exercising. But gambleification
Yeah.
is different.
How so?
Well, Zweig says that many trading apps are using tactics straight out of casinos
Wow.
to exploit those psychological vulnerabilities and encourage you to trade impulsively.
Interesting.
He talks about these bright, flashy interfaces.
Slot machines.
Exactly. And then random rewards.
Like confetti or scratch-offs.
Yeah, and all those notifications.
Oh, yeah, those are the worst.
They keep pulling you back in.
Right.
And then badges and trophies
Oh, gosh.
for trading.
Really?
And lists of hot stocks.
Mm.
And features that encourage copying other people's trades.
Wow.
It's all designed to keep you hooked
Like an addiction.
and trading more,
Right.
regardless of your goals.
It's all about maximizing their profits.
Yeah.
Not yours.
He even shares a personal story
He does.
about getting sucked in himself
Wow.
while testing one of these apps.
So it can happen to anyone,
Exactly.
even the experts.
And he also cites research showing how these rewards and features
Yeah.
can really increase trading frequency and risk-taking.
So it's not just anecdotal.
No, it's backed up by data.
It's a real problem.
And this leads into his next point, which the faster you run, the behinder you get. So what does the data say
Yeah.
about people who trade frequently?
Versus those who take the long view.
Well, the statistics are pretty eye-opening.
Okay, tell me more.
Studies from all over,
Yeah.
the U.S., Brazil, Taiwan,
Oh.
they consistently show
Yeah.
that those who trade the most They underperform those who trade the least.
That's significant.
He even mentions that a lot of active day traders end up losing money.
Wow.
And the ones who keep trading the most are often the ones who've lost money in the past.
So they're chasing losses.
It's a vicious cycle.
It is.
And he highlights the difference between the stock market as a positive-sum game, where you're a long-term owner and companies grow, and it becoming a negative-sum game when you treat it like gambling.
Because you're missing out on those long-term rewards.
Exactly.
And you're racking up trading costs and taxes.
It's a recipe for disaster.
It is.
Now, Zweig also addresses the argument that all this gamblification is somehow educational for young investors.
Interesting take.
What's his counter-argument to that?
Or you make some powerful comparisons.
Okay. He says it's like teaching responsible drinking.
Okay.
By encouraging risky behavior.
Oh, I see.
Or teaching safe driving.
Right.
By letting people drive recklessly.
That's a good analogy.
Or teaching firearm safety.
Yeah.
By letting people handle guns carelessly.
That's a strong point.
So he's saying encouraging reckless investing.
Right.
It's not educational.
It's dangerous.
Exactly. It can set people up for financial trouble.
You're not learning good habits by practicing bad ones.
Right.
It's setting you up for failure.
Now, shifting gears a bit.
Okay.
Zweig talks about the wisdom of crowds. And then the madness of crowds.
Interesting.
So initially, the idea of following the crowd can seem reasonable.
Right.
Why do you think he acknowledges that?
Well, I think it's because in many areas of life, the collective judgment of a crowd can be pretty accurate.
Right, like popular restaurants or highly rated products.
Makes sense.
We trust those recommendations.
We do.
And we learn from other people's experiences.
Right.
And it feels safe to be part of a group.
Yeah, it's a natural human tendency.
He even mentions those meme stock surges in 2020 as an example of the crowd's power.
Right.
But then he presents the counterpoint, the madness of crowds.
Okay.
So what can turn that collective intelligence into folly?
Especially in the financial markets.
Well, he compares it to that famous ox-weighing experiment.
I'm not familiar.
It's where the average of the crowd's guesses was surprisingly accurate.
Wow.
But he contrasts that with today's online financial communities.
Okay.
So in the experiment,
Yeah.
people had diverse independent opinions.
Right.
They weren't influenced by each other. But today,
Yeah.
we have these echo chambers online where everyone's reinforcing the same ideas,
Yeah.
often based on emotions.
Not logic.
Exactly.
So what's the difference?
The weight of an ox.
Yeah.
It stays the same no matter what people guess.
True.
But market prices,
Yeah.
they can be swayed by those emotions.
Even if they're unfounded.
Right.
And social media definitely plays a role here.
It amplifies everything.
It does.
Zweig explains how simply being aware of what others are doing can change your own thinking.
Even unconsciously.
Right.
And those algorithms.
Yeah, those sneaky algorithms.
They're designed to show you content.
From people who agree with you.
Exactly. Creating those echo chambers.
It's like a self-fulfilling prophecy.
It is.
And it leads to more trading
Yeah.
and lower returns.
Because you're not thinking for yourself.
Right. And those likes and positive feedback,
Yeah.
they trigger those reward centers in your brain.
Making you want to follow the crowd even more.
And then the fear of missing out,
Oh, yeah. FOMO.
it creates anxiety.
Making you second guess yourself.
Exactly. So it's like this reality distortion field
It really is.
that prevents you from thinking clearly.
So how do we protect ourselves?
Well, Zweig has some great advice.
Okay, I'm all ears.
First, be selective about the communities you join.
Okay.
Find groups with similar values. He uses the analogy.